again and welcome back to another session of Commerce class with me, Suman Rathore. Students, in our previous video, we got a basic understanding of straight line value method and written down value method of depreciation. Now today, we'll see how to prepare accounts. But before going there, let's discuss some important points relating to depreciation. So first is, under straight line method, amount of depreciation remains same as we have discussed in our previous video also. And depreciation is calculated on the cost of asset. Okay, and this cost of asset includes all kinds of expenses that are incurred for making the machine or the asset useful for the business, like its erection, its installation, its carriage, etc. And under written down value method, amount of depreciation changes every year. It just keeps on decreasing every year. And depreciation is calculated on the written down value of the asset or the diminishing value of the asset. And again, for better understanding of these 2 points, you can check my previous video where I have explained these concepts elaborately. Okay, now third is, when the rate of depreciation is given with the word per annum. Okay, now pay attention here, it is very important. Like if the rate of depreciation is given as like 10% P.A or per annum, then depreciation is charged for the exact number of months for which the asset was owned by the business. So here the date of acquisition or purchase of asset is very important. But if the date of purchase of asset is not given, then obviously depreciation will be charged for the full year. And fourth is when the rate of depreciation is given without the words per annum, like it is given simply as 10%. In that case, depreciation will be charged for the full year. Okay? So let's start our today's session now. So I'm taking this question from Arya Publications Goel and Goel, chapter Depreciation, question number 6. And if you don't have this book, don't worry, you can find the question in description box also. So let's start it now. So in depreciation, we basically prepare 2 accounts, asset account and then depreciation account if provision for depreciation is not maintained. But if provision for depreciation is maintained, in that case, provision for depreciation account is also prepared. So we'll cover that in our coming videos. But for now, let's just move step by step and understand how to prepare machinery account, which is the requirement of the question also. So here it says that on 1st January 2016, A Limited purchased a machine for rupees 2,40,000 and spent rupees 10,000 on its erection. So the total cost of machine here will be 2,40,000 plus 10,000, which makes it 2,50,000. Okay, and the journal entry of this transaction will be machinery account to bank. So we'll write it like to bank. And here let's just write the date first, 2016 January 1st. And if you read the question, you will get to know that we have to prepare this machinery account for 3 calendar years. So this marking of year is very much important here. Okay, so to bank, and the total cost of machine is 2,40,000 plus 10,000 on its erection, right? So the total cost of machinery is 2,50,000. Now we have to provide depreciation on this machinery, and if you read the last line of the question, it says that show the machinery account for the first 3 calendar years after charging depreciation at 5% by straight line method. So here they didn't use the word per annum directly, but indirectly they are saying after charging depreciation. So it ultimately includes the word per annum if you read it carefully. Okay. So here depreciation's entry will be depreciation account debit to machinery account. So we'll write by depreciation, and depreciation is provided at the end of the year. Calendar year ends on December 31st, right? So the rate of depreciation here is 5%. So 5% of 2,50,000 for full calendar year will be 12,500, right? Now it says that on 1st July 2016, again in the same year, they have purchased an additional machinery costing rupees 1 lakh. So we'll make the entry like July 1st, same calendar year 2016, to bank. Let's mark it machinery 2 and this is machinery 1. Okay. So to bank and the cost of machine is 1 lakh. Right. Now we have to provide depreciation on this machinery also. Again, write the date December 31st. By depreciation, let's mark it number 1 and number 2. Okay. So 5% of this 1 lakh comes to 5,000. But here the machinery is purchased on 1st July, right? So depreciation will be provided for 6 months only, from 1st July to 31st December. So 5% of this 1 lakh comes to 5,000 and for 6 months it will be 2,500, right? Now, as no other transaction is here in 2016, so let's just balance the account. So it will be by balance carried down for machinery 1, it will be 2,50,000 minus 12,500. So it will come to 2,37,500. Okay. And for machinery 2, 1 lakh minus 2,500. So it will be 97,500, right? Now make the total 3,50,000 on this side and 3,50,000 on this side. Okay. Now this closing balance of 2016 will become the opening balance of 2017, right? So we'll write it like to balance brought down machinery 1 is 2,37,500 and machinery 2 is 97,500, right? Now, as nothing new happened in 2017, so we'll simply provide depreciation at the end of the year, which is December 31st, and we'll mark it like by depreciation 1 and on machinery 2. So here, as we are following straight line method, so amount of depreciation will remain same, right? So on machinery first, it will remain same 12,500, but for machinery 2, here in this case, in 2016, we have provided depreciation for half year only. But now, we have to provide it for full year. So, the full year's depreciation on this 1 lakh was 5% of 1 lakh was 5,000. So, full year's depreciation will be charged this time. So, depreciation on machinery 2 will be 5,000. Okay. Now again, close the account and transfer the balance. So, by balance CD 1 and 2. So, 2,37,500 minus 12,500 will come to 2,25,000. And for machinery 2, 97,500 minus 5,000 will come to 92,500. Okay. Now the total of this side is 3,35,000 and this side is 3,35,000. Right. Now again, let's just transfer the balance. So the closing balance of this 2017 will become opening balance of 2018. So mark it like 2018 January 1st. to balance BD. Machinery first is 2,25,000 and machinery 2 is 92,500. Okay. Now it says that on 1st July 2018, the machine was purchased on 1st January 2016 was sold for rupees 1,43,000. So here we are talking about this machinery 1. So machinery 1 was sold for rupees 1,43,000 on 1st July 2018. And on the same date, a new machine was purchased at a cost of rupees 2 lakh. So here, let's make the entry of new machine to bank and machinery 3 amount is 2 lakh. Now let's make the entry of sales. So here we have sold our own machinery. So before selling it we have to provide depreciation also. But depreciation will be provided on the machinery for the period for which it was with the business. And it was sold on 1st July. So depreciation will be provided for the first 6 months at least. So the date here will be July 1st and we'll write like by depreciation on machinery 1 half of 12,500 because 12,500 was full year's depreciation. But the machinery was sold on 1st July, so half year's depreciation will be provided on this machinery. So half of 12,500 comes to 6,250, right? Now, the machine was sold for rupees 1,43,000. So we'll write like by bank, date will remain same, 1,43,000. Now, for profit or loss on sale of this machinery, let's see the working note. Okay, now for calculation of loss on sale of machinery 1, please pay attention here. Value of machinery 1 on 1st January 2018 was rupees 2,25,000, right? Then on this 6 months depreciation was provided, right? Which will be deducted from this amount. So 6 months depreciation. So half of 12,500 comes to 6,250, right? Now the value of machinery 1 on 1st July 2018, date of sale of machine was rupees 2,18,750, but it was sold for 1,43,000. So now the loss on sale of machinery is 75,750. So let's just enter this amount in our account. So now let's just write the amount of loss in our account, and this loss will be transferred to profit and loss account, and in brackets write loss on sale of machinery. Okay, date will remain same and the amount of loss was 75,750, right? Now this first machinery's account is all closed. Now depreciation will be provided on our second machinery and on our third machinery. So we'll write like by depreciation second machinery and depreciation on third machinery. So depreciation on second machinery is rupees 5,000, full year's depreciation. So we'll write it like 5,000 here, and the third machinery which was purchased on 1st July 2018, so half year's depreciation will be provided on that machinery. So 2 lakhs 5% comes to 10,000, but we have to provide half year's depreciation only. So it will come to 5,000 depreciation, half year's depreciation on this third machinery. Now that we are done with the accounting of all 3 years, so let's just balance it and close the account. So December 31st by balance CD of second machinery this time. First was sold off. So second machinery and third machinery, right? So now here second machinery has balance of 92,500. From this we have to deduct the depreciation amount. So the closing balance of this machinery will be 87,500. Okay. And now the third machinery is of 2 lakhs rupees. On this machinery 6 months depreciation was provided at the rate of 5%, which comes to 5,000. So 2 lakh minus 5,000 is 1,95,000. Right? Now let's just close the account. 5,17,000 on this side and 5,17,000 on this side, right? So this is how we prepare machinery account by following straight line method. So now in our next session, we'll discuss written down value method. Until then, keep practicing and don't forget to like and subscribe my channel. Thank you and goodbye for now.